Hello, this is Karsten versus the market. So this video is basically a crash course to options for the purpose of trading with options. Now, in my opinion, the information that I'll be sharing with this video is basically all that a person needs to know in order to begin successfully trading with options. There is, of course, a lot more detailed information that a person could choose to learn about options, especially if they are interested in a strategy that is different from the two particular strategies that I'll be talking about with this video. Nonetheless, this basic beginner to intermediate level information that I'll be sharing should be sufficient for a person to begin trading options. Now, first of all, yes, this is Robinhood. In other videos, I'll be using other platforms like Webull and others as well. However, Robinhood seems to have one of the simplest designs for options, so it made sense to start with it for now. So let's say I'm looking at this stock for starters, ticker symbol SOLO. It's basically an electric vehicle stock. Now, there is honestly no particular or great reason why I chose this stock. However, it seems like a pretty good example for starting out. So let's say that you were looking at this stock and you're checking out the chart and you notice that for a few months now, the share price has been steeply declining, which is the case for many stocks right now because of inflation, job shortages, supply chain issues, Fed rate concerns, and now the war. Let's say you also notice that the current share price is pretty much near the all-time low. So let's say that you're sure that this stock is worth buying and holding for the future because you think it should for sure rally or recover at some point. Well, the first options trading strategy that I'll be talking about is a way to buy and hold this stock for later, and also I'll explain why options may be more appealing than shares. As for the second options trading strategy, which is a lot more short term, let's say that you notice that this stock is about to report earnings in a few days. Now let's hypothetically say that you checked the dates and all of these sudden spikes in value happened right after earnings. Not saying that is the case, just saying what if? Well, in that case, you may want to short-term trade the earnings report as a catalyst that the stock may or may not react to. The second options trading strategy, thus, that I'll be talking about, is basically one where you can do this, but it'll be safer than simply gambling on what you think earnings will be. Now, with that said, I'll first explain a bit about how options work. So if we select trade, we can then select trade options. Now, some stocks don't have options, so there will just be a buy button with which to buy shares. However, because this stock does have options, there was a trade button at which we could either buy shares or, in this case, click to trade options. Now, this initial homepage here is Robinhood's way of helping you get started. However, for the purpose of this tutorial, we will skip it, and I will select March 18th. Now, the buy and sell options here, you just want to leave this on buy for now. We'll talk about sell another time. Now, calls are what you buy if you believe that the stock price will go up, and puts are what you buy if you believe that the stock price will go down. Put options are basically how you short a stock with options. Now, all of these options here, this is the options chain for SOLO And these are all contracts that expire March 18th. Just like if I press March 25th, then these are all options contracts that expire on the 25th. So you'll notice the bar here that says share price, 185. That's basically the current share price of the stock. And the contracts below that share price are what they call in the money contracts, and the options above the share price are what they call out of the money contracts. Now, I think with Webull, the order is the opposite. Like in the money or out of the money may be above or below the share price, depending on what platform you use. But the point is, if the strike price is less than the share price, then it's an in-the-money options contract. And if the strike price is above the share price, then that is an out-of-the-money options contract. Now, the strike price is what you notice next to call here. $2 call, $2.50 call, $3 call. That dollar value is the strike price. There is some basic information right here that we can view for each contract. For example, with the $2 call here, $2 is a strike price, and this is a call option. And the break even is useful. It's 205. That means if you were to buy this option here, you would need the share price of Solo to rise above 205 if you wanted to start profiting from it. And then this 0.05 value over here, that's the premium. That's how much you'd have to pay. If you select the value or press the plus sign, this is where you can buy this option contract. So, for example, you'd probably pay $5 to buy one $2 call option that expires March 18th. Or you could change it to buy two of them. And of course, two at $5 each would be $10 that you pay instead. Now, if you simply press the options somewhere in the middle here, you'll get more information, like the volume, how much buying and selling is occurring for this option lately is basically what the volume is. And I already noted the price, and the implied volatility can be interesting. I'll explain more of that later. As for the Greeks, the statistics at the bottom will mostly discuss theta, which is basically time value. So if you want to know how much will your option be worth while you're holding it, how its value is decided, how it's decided how much you have to pay to buy it, or how much profit you can expect to make from it if the stock does what you think it will, there's a few ways to calculate that value. First of all, there's an inherent value. For example, if I bought this $1 call here, well, if the stock price goes up, then I could sell this option at a profit. But if I wait until March 18th and I let this option expire, then it expires worthless and I lose my money. Let's say the stock goes down and I can't sell this option for a profit, and in fact, I can't even sell it for a loss because no one wants to buy it on the day it expires when it's not worth anything. Instead of letting it expire worthless, you could instead exercise the contract. The $1 call option represents 100 shares. Every contract does. So, if I wanted to exercise this call option here, it would basically let me buy 100 shares at $1 per share. So that ties into the inherent value I was talking about. Let's say I buy this right now, this call option, the $1 contract. And let's say I immediately exercise it. I buy 100 shares at $1 per share. Well, the current share price is $185. That means I can instantly sell those 100 shares for 85 cents per share profit, which means I would be turning $100 into $185. However, the premium, the value you have to pay to buy this contract over on the right, is $86. So if I were to buy this, exercise it into 100 shares at $1 a share, sell them at $185 for $85 profit, I would actually lose $1 because I paid $86 to buy the option. And that is basically what the inherent value is how much value the contract would be if you exercised it into shares and sold those shares. That's why these in-the-money contracts cost a lot more than these out-of-the-money contracts, because the in-the-money contracts already have an automatic intrinsic value. As for these out-of-the-money contracts, their only value is based on time and also some other factors, like, for example, hype or the implied volatility I mentioned. Like how much the stock is moving and how much people want to buy this option can drive the price up. And aside from that, the key one is basically the time value. So this expires in like 6 days. So if I bought this for $5, then I would pretty much expect that each day, Monday through Friday, it would probably lose at least $1 of value until it was worthless on Friday. That's kind of what this time value here is all about. Of course, if the stock price climbs to over 205, then there would start to be some inherent value to this contract. And also, there might be some more value from not only the inherent value, but if there's any time left, and if there's a lot of people interested in it, then the price could go up. But in general, let's say that I expect this stock is going to rally to $4 at some point. Well, then I don't want to buy the $4 call because I won't even break even until 401. So if I only think it's going to climb to $4, then there's no way I want to buy the $4 call. I'd want to buy the $2 or $3 call, because then I'd break even at 205 or 301, and everything else above that would be profit. Now, aside from the time value and the interest value and all that, in basic terms, the simple way to figure out basically how much profit you would make is if I bought this $2 call while the share price is right around $2, and then if the share price climbed to $4, I could expect to at least make $200 profit. Because, again, if I were to exercise the $2 call I bought to buy 100 shares at $2 each at a time when the share price was $4, then I could immediately sell it, and the other $200 would just be profit. So that's basically how you can kind of decide how much profit you'll make. And again, it can vary a bit with how much time is left on the contract and how much interest or volatility or volume or hype that there is as well. So if I think the stock is going to go down, as I was mentioning before, then instead of buying a call, I'd want to buy a put. And then it would kind of be the same principle. And now you see that which ones are in the money and which ones are out of the money has flipped. And that's why these are now more expensive and these are suddenly now the cheaper ones, because the direction that you want the stock to move has changed. So, returning to the first strategy that I mentioned, if you just want to hold this because you think in a few months or so it's probably going to recover, rally a few dollars, then what you could do is you could select the January contracts for next year. And if you buy this $2 call option for $70 per contract, then you could hold that all year pretty much. And as long as any time by January, this stock recovered a bit, like the $2.50, $3.50, or $4 per share, then you could probably sell this contract or exercise it for about $50, $100, $150, or $200 profit. And the sooner it did it would be better, because then there would be some time value. And the more attention the stock gets could also add to its value further. But basically, you could expect that $200 profit if it got up to about $4. And that would give you plenty of time also. Sure, it's cheaper to buy one that expires in a month, but there's far less chance that it'll actually rally that high in just a month instead of a year. Now, the reason that options may be appealing instead of shares is because if I wanted to buy 100 shares, so I could make about $200 if the share price went up to $4 per share, well, I'd be paying $185 for those 100 shares. Well, instead of dedicating $185 of my capital, I could simply buy that $70 call option instead. So instead of spending $185, I'd only be spending $70 to get the exact same profit. Of course, the option contract has an end date, so that's kind of the risk. And you can lose that $70 way faster than you would lose the $185 if you bought shares instead of options. But as long as your option has plenty of time and the strike price is pretty close to the share price, then it could work out. Or worst case scenario again, when January starts to roll around, if the price hasn't really changed much, you could worst case scenario exercise the contract into shares instead of letting it expire worthless. Now, as for the second strategy that I mentioned before also, where if we just wanted a short-term options trade, the earnings, it says are on March 22nd. So the March 25th options could work, but again, when you don't give yourself very much time, you risk losing a lot more value. And so for the other reasons as well, you'd probably at least want to buy the April 1st contract. So if you think this earnings, it could go up, then you might be interested in this $2 call option for April. However, again, you don't really know what the earnings are going to be and what the stock's going to do. So you don't just want to just buy it and gamble. So that's why the second strategy has a second detail to help you avoid that. What it is you would still buy this $2 call option, but then you would also buy a put. For example, this 150 put here. So if you pay about $15 for this $2 call, and you're right, and the share price climbs to $3 or $4 per share, then you could sell this contract for $100 or $200 profit at least. Well, then what about that put you bought as a safety protocol? Well, no worries. You only paid about $10 for it. $100 or $200 profit well outweighs that $10 for the put. But what if you were wrong and the share price goes down instead of up? Well, then thank goodness that you have this put to sell instead at a profit, which may replace the loss from your call. And in some cases, both the call and put will be profitable, because a significant change in price sometimes gets people interested in buying the opposite direction as well, thinking, oh, this is going to probably turn around after this sharp change. So that it's not that you'll necessarily lose from one and profit from the other. You should profit from one, and then the other you may profit, lose, or even break even on. Now, worst case scenario with this strategy of buying the call and the put is, what if the earnings are bland and the share price doesn't change? Well, if this share price just moves sideways and not up or down, well, then as long as you have plenty of time and you pick good strike prices, then hopefully you could just break even, sell your call, sell your put, and move on. Or you might take a minor loss, or you could exercise into shares or whatever else you chose to help minimize. However, the strategy works pretty well. Now, the last thing I'll say for this video is, honestly, if you were looking for a stock to use the first strategy with, to buy a long-term option, something like AMD would probably be a lot more appealing. It's down to $100 from $160. It's a great stock. Its fair value is considered to be $130 per share by Morningstar. Its earnings just keep getting better every quarter. So honestly, if I was going to buy a long-term stock, it'd probably be something like AMD. I'd love to have a $115 or $130 call option of AMD so that whenever it eventually, in my opinion, inevitably recovers to $130 or $160 per share, or perhaps even higher someday, that call option would return a nice profit. As for the short-term trading strategy, there's also better examples than Solo. Just like AMD is a better example than Solo for a long-term strategy, NIO may be a better example for short-term strategy because it also has earnings soon, and it is more often reactive to earnings. So there's a higher chance that you'll get some activity right before earnings and that you'll have some kind of reaction to the earnings. And also, it looks like the last 3 earnings were better than expected, which sometimes can help as well. Now, the only thing I'll say about this that I notice is that it's reporting its earnings after hours, which reminds me of a good point to mention. You can only trade options from 9:30 a.m. to 4 p.m. You can still trade shares from 9 to 9:30 a.m. and from 4 to 6 p.m., but options you can only trade from 9:30 to 4. So, if NIO has great earnings after hours and it starts to go crazy, well, you better hope it doesn't fizzle back out too much before the next day when you can actually sell your option. However, again, if you're buying the call and the put, then you'll probably profit or break even regardless, or there should be ways to minimize the loss at any rate. And also, one last example of why options may be appealing, it sort of relates to the example I already gave, which is like with Solo. Why pay $185 to make $200 profit if you can just pay $70 with options instead of shares to make $200 profit? Well, with a stock like AMD, some people can't really afford to buy a meaningful number of shares at $100 per share. Instead of trying to maybe put $1,000 into AMD so you can have 100 shares that may return you $300 to $600, you could just probably buy a few $100 option instead of $1,000 worth of shares. A few $100 worth of options would probably have the same or even a better return. So sometimes options are cheaper than shares. But that's about it for now. There's probably a lot of things that require some clarification, or the kind of things where you just kind of need time to really understand or figure them out or find a way that it works for you. But hopefully this video is helpful regardless. And as usual, as you'll probably hear anyone say with a topic like this, I'm clearly not a financial advisor. I am sharing for fun because I enjoy it, because I like to share what I do, and basically just for fun, educational, theoretical purposes. Always be sure to make your own decisions and do your own research. And with that said, have a good one.